Hey guys, thank you for tuning in to another episode of the Excel Man. Today we're going to talk about the 5 best finance functions you need in Excel. And this is going to be a series where I will dive into each of these sub formulas as they listed here and talk to you about the top 5 most useful one and review and go through each one of them. So let's get started and review what we need to talk about. So the first thing we're going to talk about is a payment option. So let's review what the payment option is. It's used to calculate the payment of a loan based on the consistent payment and consistent interest rate. So let's run through an example real quick. So our example is going to be to determine the monthly payment on a $100,000 loan with a 5% interest rate over 20 years. Now, this is what your function looks like, and each of these are described here. First thing we're going to do is we're going to determine the rate. That is basically the interest rate of each period, the total number of payments for the loan, and the present value of the total loan, of the total amount of the loan. The other two are future value and the type. Those are optional, and we won't need that in our example. So the first thing we want to do is figure out your interest rate. Now, most loans are advertised as annual interest rate, but since they're paid monthly, you would have to divide that number by 12 to determine the monthly rate, which we did here, 0.05 divided by 12, and then you want the total number of payments. It's 20 years, and multiply that by 12. That gives you 240, and your loan amount is 100,000. So let me show you what it looks like when you enter it into a function. Anytime you want to search for a function, always start with your function bar, do your enter, and type in your first 3 letters of your function, and usually it's the top one. Press tap to open and start with your rate and your time and your loan amount. Easy peasy, and gives you a total. Now, I strongly advise that when you guys are dealing with these functions, create your data in a way that's cell reference and it's not hard coded, so it could be adjusted. So for example, if you were doing your monthly totals and you wanted to change the repayment portion, how many repayments, and you want to do 30 years, you just enter that in and your function adjusts the outcome. So that's your payment function. Your next function we're going to talk about is your future value. So your future value, as we go here, your future value estimates the future value of an investment based on the periodic consistent payments and consistent interest rate. Great tool to use to determine if you invest a certain amount of money each month with a certain interest rate, what's it going to be in today's number. Great way to determine if you're trying to save a investment, it's trying to save for an investment. I'll tell you what the future value of it is in today's dollar. So let's go through a quick example. Calculate the future value of a monthly deposit of $500 in a savings account with an annual interest rate of 3% over 10 years. This is what your function looks like, and it's the same as your payment. The only difference is instead of future value, you have payment. So we do the same thing. We break up your data. You say 3%, divide that by 12. That's your monthly rate. You'll be doing 10 years, so divide that or multiply that by 12. That's your payments, and your it's $500 that's going to be going out. So let's show you what that looks like. Get your value, do your rate, time, and your payment. So this is the beauty of compounded interest. So in another video, we'll talk about some financial concepts that's great for investments. But anytime you invest money and it creates interest, because we have time value of money, it maintains that interest and then compounds on each other. So if you save $500 a month, 3% interest for 10 years, in 10 years, that $500 initial investment will turn to about $70,000. Our next one we're going to talk about is net present value, which is assess the profitability of an investment by calculating the present value of an expected cash flow minus the internal investment cost, excuse me. So let's do a quick example. Say, imagine evaluating a project requiring an initial investment of $50,000, expected to generate $10,000 cash flows for 7 years with a discount rate of 5%. This is what your NPV function looks like. Basically, it's the rate, your discount, and your cash flows. And this is specific because you're going to need to deduct the 50,000 out of the total to see what your profit is. So that's your initial investment is 50,000. Expect cash flows 10,000 for 7 years, and that's your rate. So let's break down your data. Every time you have a spreadsheet and you're calculating data, as I mentioned earlier, make sure you have your numbers as a cell reference and it's not numerically entered into your function, so you can change it after. So this is what the function looks like if you put numeric, but we're not going to do that. We're going to do it a little differently. So I want to give you guys an idea of what it would look like by itself. So type in NPV, as you can see, enter tab, and NPV, enter tab, opens it up, rate is 5%, payment is, oh, sorry. I'm like, wait, there's no payment. NPV is this one. So rate is 5%, and your cash flow is your range, close parentheses. That gives you the net present value of your investment, 57,868 out of a 7-year with $10,000 cash flow each year. But we want to initially take away the initial investment, which is here, and you will see, oops. I'm going to add that. Okay. It's a negative number. So after initial investment and a 10-year stretch with $10,000, you're still positive. Now you can determine based on your own criteria if your margin is greater or not, but this by its definition is a good investment. So your next function we're going to talk about is your XIRR, which is your internal rate of return, which is a very common ratio that we use in finance, but this is different because this has abnormal cash flows. And so it's very simple. It's just taking the value, the dates, and giving you a return. So list all the cash flows and the corresponding dates, which we did, and then you just go into your function. So your function is XIRR, opens up, value, and dates. And it equates to 15.42%, which our example was, suppose you want to calculate the IRR of a project where you invest $100,000 followed by irregular annual cash flows. So this will tell you that it's a positive, anything that's a positive integer or positive rate, that tells you it's a good investment. If it's a negative, that tells you it's a bad investment. Great useful tool for any kind of small business wants to capitalize on a equipment. You just determine your cash flow. It could be irregular, and then your dates, and enter into this function, and it tells you your percentage. And our last function we're going to talk about briefly is your rate function. This is a great tool to use if you want to determine what your interest rate should be on an investment, or if you have a future, if you want to save something for 5 years and you want to know what kind of rate you need. Great tool. We'll dive into the example. So it says, imagine you're planning to save for a future goal of $50,000 and you want to make monthly deposits of $500 into your account. You want to determine the interest rate needed to reach this goal in 10 years, 120 months. So this is what your function looks like. Basically everything we talked about. You can read to pause these. Your first step is going to be determine your total number of payments. And like we did before, it's 120. And your savings is 500. And your future value is 50,000. So this is what your rate is going to look like. To show you what this is equivalent to, what we'll do is we'll take that out, and then we'll show you. So you enter in your rate function, NPV is 20, and your payment is 500, Now your present value, you're gonna need to enter this. So your present value is the present value of a total number of a series of future cash flows is worth now. And since you don't have any money right now, that's a 0. And then your future value is gonna be 50,000 because that's gonna be how much you wanna save by the end of the cycle of payments. So once you enter that, close that up. As you can see, it's a smaller number. So all you do is you increase your integers, and as you can see, when it's hard coded, it's the same number. So this tells you that this is not feasible. So you either need to increase your payments, increase your total number of payments, or do something because your interest rate would be a negative, which is not practical. So these are the top 5 finance functions. If you like this kind of stuff, please subscribe, comment. If you want to talk about any interests or any function, you can dive into that. But thank you guys for watching. Please subscribe.